Hey everyone, what's going on? It's the first day of lockdown, but that doesn't mean I still can't do accounting stuff with you. So hopefully you do go through this. So today I'm actually going to be doing chapter 12.9. And I know that's not part of your coursework, but I do want you to have a go at this exercise at some point, especially in the lead up to sacks, because we do have a sack at this stage at week 3. I don't know how that'll look at the moment. I'll probably get more details later in the week when I know more information. So we will talk about that then. Obviously, this is the 16th of July. So if you're watching this later on, then hey, maybe we got out of lockdown. Anyway, we're going to be doing 12.9. I've got some messages there, we've got an assistant, and I've got my water, so I'm quite happy. Anyway, if you could go onto your textbook, and I'll just bring it up on my computer. We've got, okay, I just can't get it to work, but we've got exercise 12.9. I'm going to be doing this off the computer, page 297. And in your workbook, it'll be page 230. So we're going to be reporting and managing inventory. And this is for, I think it was Antonio's Antique Arts. Oh, no, just Antique Arts. So I'll sort of go through that now, and then I'll switch over to the schoolwork. So I'm going to have the book open at my lap, or just on the side here. So you should be following along as well. So I'll just make that bigger. All right. Mario Belletto is the owner of Antique Arts, an art dealership in Moonee Ponds. Inventory is recorded using the perpetual system, and it's FIFO, first in, first out. And you're given the following bits of information: credit sales, cost of sales, inventory on hand at the start, inventory on hand at the end. He used to own a fruit shop, which consistently generated an inventory of 6.2 days, and he's been quite disappointed with the inventory turnover of Antique Arts, which is, well, 165 days for the year ended 30th of June 2024. So you've got a few different numbers there. And then we, for A, need to calculate inventory turnover, B, what we think about it, C, percentage markup, D, whether markup could play a role on inventory turnover gross profit, so a bit of theory. You're then given the information, a new set of information for August 2025. Now, one thing, I'm just going to have a look. One thing I want to point out here, August 1st, the same as, whoops. No, that's different. So we go August, we skip July. That's interesting. So we do skip July, so never mind. I thought I saw something, I didn't. So we're given inventory at start, sales returns, capital, cartage out, drawings, cash at bank, credit purchases of inventory, wages, packing expenses, and advertising. And then using that information and the additional information here, where at the start of August, Mario introduced a new packing system for small antiques, sealed in bubble wrap. Drawings consisted of 1,600 and what the lamp was, so you need to play around with that. And on the 31st of August, physical count revealed 6,500 inventory on hand, but the inventory card showed only 6,100, so that's we'll need to account for that as well. So that's going to be inventory gain, inventory loss. So for E, we need to calculate cost of sales. We need to prepare an income statement. We need to prepare the owner's equity section. So just an extract. H, we're going to talk about what we do if we don't put drawings. We're going to explain one inventory management practice principle other than establishing minimum and maximum level that Mario could implement. J, we're talking about the gross profit margin, net profit margin, calculating and explaining. And then it provides us context with the industry average, and we got a bit more theory there. So without further ado, I'm going to set up our work. So let's do it to it. So hopefully, no, never mind. I will be merging this on the go. Great. All right. So we need to calculate inventory turnover, and this is A again, for the year ended 30th of June 2025. And that should be 2024 on your book. On my book it says 1st of July 2015, so we'll just come back. Sorry, we'll just come back, and you see same mistake here. So that should say 2024 because they're going year ended. That should be 1 July 2024. It doesn't have a material impact, but it's annoying. So let's get our calculations underway. So formula. Let's put in the formula. So we're going cost of sales divided by okay, I've just gone at the end apparently. Sorry, having a good run of it. Oops, it should be average inventory, my mistake. So it should be average inventory over cost of sales, and our average inventory, if we remember, is start plus finish, over 2. So we go 7,400 plus 7,800 would give us a middle ground of 7,600 because that's in the middle. And if you want, you could add it up. It would come to 15,200, which makes it that amount. So let's get back onto the page we need to be on. So 7,600 over the cost of sales, and we're using the top number, so we go 19,000 multiplied by 365. So I'm just going to put my calculator app up. I'm just going to have that off to the side. So 7600 divided by 19000 gives us 0.4 multiplied by 365. That gives us 146 days. That's our answer, 146 days. B. Referring to your answer in part A, state 2 reasons why Mario should not be disappointed with the inventory turnover for the year ended 2025. We just need to give 2 reasons. So reason 1, a reduction of, how many days is that? 19 days, 165 down to 146. So that's one answer. And another reason, let's see. Referring to your answer in part A. Now, I think the other reason he should be happy, and I'm just looking at part A, we're still turning over inventory. So inventory is being turned over via cost of sales. Very tricky question there. So that's B. Now, I am going to be moving at these at quite fast, so I'm hoping to probably get this done in about 15 minutes. So, markup percentage. So, calculate the percentage of markup Mario has applied to his inventory. All you're doing here is your sales, 47500 minus divided by 19000 in brackets. Sorry. Let's just get that right. Whoops. And minus 19,000. Now, the reason we minus 19,000 because we need to know how much profit we're making. Obviously, it's a percentage amount, so we will multiply it by 100. So, on that note, let's bring up the calculator again. Let's see, can I get the calculator on the screen? No. Probably should have screen shared, but oh well. 47500 minus 19,000 gives us 28,500 divided by 19,000 multiplied by 100 is a 150% markup. So that means we are timesing the cost price technically by 2.5, so we get the 100% markup. So if you double your price, you are providing a 100% markup. And if you're tripling your price, it's a 200% markup. So just remember that. That's where the 150 works out. 4D. Explain how decreasing the percentage markup may affect inventory turnover. So inventory turnover is affected by decreasing the markup percentage because it will mean more sales are made, hence lower inventory turnover amounts. I'll just merge that as we're talking. And how would gross profit be affected? Gross profit would be affected by potentially going up or down. This is important to note. So it could go up because the increase in sales is worth more than the decrease in markup. Alternatively, the opposite could happen if sales volume doesn't increase. And I'll put a bit of a mini example here. So let's say S1, situation 1, sell 10 at 10. And cost is 5. That would mean my gross profit in this case would be, $50. All right? Because $100 revenue, $50 cost price checks out. But if I was to lower my sales price or my markup, so 10 at 7.5, cost still 5, my gross profit would be 25. And that's S1. And now let's flip it around here. Let's say because we're selling a bit cheaper, we now sell 20 at 7.5 because we sell more. Cost is 5. We see that our gross profit 20 by 2.5 would be the same. So we'll actually bump it up to 30. We see we sell a lot more. We can see that, 30 at 7.5 will give us sorry, just having a bit of a issue. 30 at 7.5. 30 at 7.5. Yep, 225 minus the 150. Your gross profit now is 75. So that's sort of how that all works. Sorry about the slight delay. There was a bit of an issue just getting that to line up. There we go. All right. So that's sort of the example and the math behind it, because you lower the price. If the sales amount you sell goes up by more, it can really counteract that difference. All right. E. Let's move on to E. So now we're using the bottom set of numbers. Calculate the cost of sales for August. Now I'm going to cheat a little bit, so please don't be following my example. But I'm just going to put the start plus purchased minus start plus purchased minus drawings plus minus cost cost of sales minus, sorry, just having a look, plus minus inventory gain or loss. Obviously you would add the gain minus the loss. And we can just have a look. We see, is there anything else like sales returns? There are sales returns, but there's nothing about purchase returns, so you sort of just, you leave that as is. So we just leave that as is. Now there is a second way to check this. We will be going through that. So, start. Our inventory at start was, and that equals inventory at end, which I also have anyway. So 7,800 plus the amount purchased, 18600, minus the amount drawings. Now there were $2,000 worth of drawings, but only 1,600 of that was cash. The other 400 was inventory. We've got cost of sales, which we're calculating. We're going to make that X. We're going to add, though, we are going to be adding the inventory gain of 400, and that will give us 6,500 at the end. So what we can do is we can actually we can transpose this by adding X to both sides and minusing 6,500. Because if I add X here, it becomes X plus. So we'll go X equals, and I just redo the numbers again. Every other number will stay the same. Minus 6,500. And then we just get our final answer, which I'm just going to put that in there now. So I don't need to go the plus minus 400, so that's quite handy. So we'll go across to here. Numlock 7,800 plus 18600 minus 400 plus 400. I could have just ignored that really, and 6,500. That gives me a cost of sales of 19900. So that's the number I've been given. So I think that's quite interesting. But I do want to check one thing, so we're just going to hold tight for a minute, because I think there is a second way to actually calculate this, because we already know the markup percentage of 150%. So what we could do is, again, retranspose that number. But I think leaving it as 19,900 probably the safer bet. I just want to check one thing, because I am looking at these numbers. I'm like, that's interesting. Yes, here we go. So here's the other way. Now, we think, hey, that is probably correct, but there is actually another way to calculate it. We see that sales and sales returns gives us a slightly different number. So let's do it this way. Let's create a little gap, and we'll put the new one in. So markup equals sales price divided by cost price. Cost price equals selling price multiplied by 1 plus percentage, wherever the percentage is. I'm just trying to find it. There we go. So we can just go that, and we know the selling price, we know that we've sold 38,500 less the sales returns 1,500. So we can play it around that way. 38,500. Sorry. 38,500 divided by 1 plus 1.5, because 150, if we go up here, 150 gives us our answer. So there we are, 1.5, so that becomes 3,800, 3,700, because you need to deduct the returns, divided by 2.5, and then it becomes, let's just delete that, 37 divided by 2.5 gives us 14880, and those numbers check out a lot more healthily than what is there previously. I am really curious to see why those numbers are varying. So that has got my interest. I will have a look. I will look at that now, but you do want to go with this number. Alright, your answer should look like that. Next, we are plugging in our numbers. So let's just get this up and running. Sorry, that's deleting the row. Okay, so there's a little bit to go back and delete. A little bit to delete. Okay, that's a bit on the annoying side. I'll just plug the numbers in as we go. So we're going to start with the revenue, and we're just plugging numbers in. So we go sales revenue, and we're just going 38,500. I will tidy this up at the end. Then we're going less sales returns. And it only says the sales we made. We got less sales returns, which gives us net sales. And don't forget 1,500. And that gives us a net sales of 37,000. And you can put it here or here. I don't overly care. I'll let you pick which one. Okay? I'm consistent. I like doing it this way, but whatever works for you. Now we've got cost of sales, and we calculated that above 14800. 14800. And if we have a look through at all the other information, we see nothing else really relating to that, because packing expenses happens, if we remember, packing expenses happens when the sale's made. So very similar to freight out or cartage out. So cost of sales is the individual number there. Next, we've got inventory gain. So we just go add, inventory gain, and we're just plugging in the next number, which we equated to as being 400, and that gave us the adjusted gross profit. I'm just going to get these to line up a bit more, just so you can see the numbers a bit better in action. So we've got 37,000 minus 14,800 gives us 22,200. Adding 400 more in makes it 22,600. So that's our adjusted gross profit. Then we deduct our other expenses, and if we just go through, we see we've got cartage out as the first one. So we go cartage out and 1400. We've got wages, packing expenses, and advertising. So we just plug all those numbers in. Now, you might be wondering, hey, why is stuff like, for example, credit purchase of inventory not included? That's because it's added up in the previous transaction. Drawings aren't an expense. Cash at bank doesn't factor in either. In fact, cash at bank's a good red herring that will get thrown out at you a lot. So that's just something I think just be mindful of. Sorry, I'm just going, oh my God, that's horrifying. I don't know why that's happened. Yep, there we go. Perfect. So we go our expenses, we add that all up, and we see 1,400 plus 3,300 plus 1,900 plus 650 is 7,250. And then we just need to re-add all that in. So you just got to remember you got to minus the 7,250. So 22,600, whoops, wrong square. 22,600 minus 7,250. And that should be 15,350. That should be your final answer. And it is, and we love to see it. Next, we will be doing the balance sheet extract. So don't forget, we just go capital at start, and the owner is Mario. So we go Boletto, because that's his last name. And we just add his number in. And at the start, it was 18700. We go add net profit less drawings, and we see the drawings is 2,000 because we count everything. The net profit we get from the question above, 15350, and that will give us 34,050, and then it becomes 32,050. So that is how our numbers work out. So in our balance sheet, the owner's equity will be $32,050. So now we've got a little bit of theory to wrap up with, so I'm going to smash through that. Hopefully it doesn't take more than a minute, honestly. All right, explain the effect on owner's equity as at the 31st of August if Mario had failed to record the withdrawal of the lamp. So if Mario had failed to record the drawing of the lamp, it would mean his assets are $400 higher than they should be, and owner's equity would be $400 higher than it should be. It's just explaining the effect on the balance sheet. So you can just spell out your definitions here again, and that's what I mean by spelling out definitions. So stuff like drawings, why it's not an expense is because that's that exception. If you buy inventory on cash or via cash, assets go down, but one asset also goes up, so it's not an expense. So it's just remembering that. Explain one inventory management strategy other than minimum maximum inventory levels that Mario should implement. I think, honestly, you can pick anything from 12.8, and I'm going to say probably the really good one here is effective marketing. If I can spell marketing. And then I'll go effective marketing is something Mario should implement since he has highly specialized, sorry, I'm trying to think of the word, inventory. And it's antique art, which is highly specialized. This will inform potential customers of what art, there we go, what art he currently has for sale, leading to more sales and therefore better inventory turnover. So when you suggest something, when you make a suggestion, you need to talk about why would he actually need to do this? Because you're essentially taking the approach of, hey, I need to explain why this is a good idea. All right, J, and then we're done. J, calculation, explanation. So gross profit margin. This one's really easy. It's literally everything over net sales. So let's get it in. So we go gross profit, there we go, over net sales, and we get our gross profit numbers from scrolling up. We see our gross profit 22, whoops, I put that in the wrong square, 22,200 over 37,000. So 22,200 over 37,000, and you multiply that answer by 100. And that'll come out to something in about the 60 to, I'd say 55 to 60 range if I had to have a guess. That was exactly 60. Go me. Math. So that means for every sale the business makes, they are making a gross profit of $60. And we can see that by deducting this through. But that's where that goes. Hold on, I'm just going to double check that number. Just doesn't look right. Nope, it is 4,000. Yep, it is right. Okay. I think, yeah, because it factors in that 14,800. So that's our number we are working with. We see gross profit margin 60%. Now, if we do net profit margin, exact same setup, except the only thing that changes is that becomes net profit over net sales, and the net profit in this case was 15350. 15350. So if we put the numbers back in again, 15350 divide by 37,000, we see that I break my calculator. Wonder why that was. 15350 divided by 37,000 multiplied. What? That's... That's why. I'm just wiping the thing. So when you do new sums, make sure you actually clear everything, because
Alright, hopefully the audio is back. Yep, looks like it's back. So, just to reiterate, 15350 divided by 37,000. Divide by 37,000. Why is it giving me the exponential? Sorry. Let's just... Why is that calculator not working? Oh, so let's put that through. 350 divided by 37,000. There we go. It should be 41.48. Sorry about that confusion. Basically, my calculator decided to play up. So, here's what we do here. Explain if antique art should be satisfied with responses in J for the following industry averages if they were discovered. So we've got gross profit margin 60%, net profit margin 30%. And I would say they should be satisfied with both because the numbers recorded, the margins recorded, there we go, margins recorded have met the industry averages, met/exceeded. So that's how I would be looking to answer that. So that's sort of your summary of 12.9. Now I encourage you to do 12.9 as part of your SAC preparation. I think that's a big one, or if it's the end of the year, you're doing this as exam preparation. Now, some overall final tips. I'll just bring them up on the screen. I think the first one, especially for creating an income statement and balance sheet, all sales belong under the revenue part, while cost of goods sold consists of any cost relating to selling the product. Inventory loss or inventory gain is under gross profit to become adjusted gross profit. All other expenses go in the other expenses section. When you calculate gross profit margin, as we did, you use a gross profit, not the adjusted gross profit. You never include GST in your income statement. And if you're ever unsure if an item is an expense or a revenue, spell it out. So I'll do an example here. I'll do credit purchase of inventory. So credit purchase of inventory is something we did. Credit purchase of inventory has meant that we receive inventory, our asset goes up, cool, but our liabilities also go up. So by both going up, it means it hasn't fulfilled the definition of an expense or a revenue, because there's no change in owner's equity. So please do remember that. And lastly, if you're stuck, please ask for help, whether it's via WebEx or you message your teacher if you're watching this and you're probably not your teacher for whatever reason, or you can just put comments in the put comments in the video and I'm happy to reply to them. Otherwise, make sure to like, share, subscribe, and I will see you next time. Bye.